Hey guys, so try to visualize this. It's 1973 and FedEx, the delivery company, is bleeding money. And on a Friday afternoon, they have exactly $5,000 in their bank account. But $5,000 is not enough to keep the airplanes flying next week to deliver the packages, and the company is on the verge of bankruptcy. Fred Smith decided to grab those $5,000, go spend the weekend in Las Vegas playing blackjack, and Monday he comes back with $27,000. Just enough to save the company, to keep the company running for one more week, to have jet fuel to fly the airplanes and deliver the packages. And his business partner was furious, like, are you crazy? You go to Las Vegas and gamble our last $5,000? And Fred Smith replied, like, what will be the difference? If I don't go to Las Vegas and gamble the $5,000, we'll go bankrupt anyway. So the lesson from this story is that he ended up saving the company, right? Nowadays, FedEx is a multi-billion-dollar company. You probably use it like every month or every week. And he saved the company because of something called expected utility. You see, the expected value of going to Las Vegas and playing blackjack or buying a lottery ticket is highly negative, right? The advantage, the odds are always on the side of the casino. But the expected utility of, in this case, saving the company, transforming the $5,000 into $27,000, although the odds were not by his side, the value was not by his side, the expected utility was immense. So it would either lose the $5,000 and doesn't make much difference because the company goes bankrupt anyway with $5,000, or he will make enough money to save the company and keep the ball rolling, right? So that's what he has done, right? So tell me, what do you think? Was Fred Smith crazy for doing this crazy move and going to Las Vegas? Or he was actually the rational person in the room? And what does this have to do with your retirement account and with your investments in leverage ETFs? Alright guys, let's talk about expected utility, leverage ETFs, and why probably everything you have learned about safe investing might be backwards. Grab a coffee, this is going to be an interesting video. Hey guys, my name is Henry, 8 a.m., I'm at the office, and you know what they say? The best way to build your dreams is to wake up early. So this is what I do. I love coming to the office early. I love to leave the office late because I have a mission, and one of my biggest missions is really to build wealth for other people. Alright guys, so in this video I'm going to offer you a lottery ticket. This is a thought experiment that it's very important to understand how to manage your investments and whether you should invest in regular ETFs, in leverage ETFs and so on. So in this lottery ticket, let's say it costs $5,000, and if you have bought this lottery ticket 15 years ago, you'll now have $1.6 million. Very, very interesting, right? And I also have run some Monte Carlo simulations. Monte Carlo simulations allows you to do like 1,000 different simulations. So you can get 1,000 different lottery tickets, and that's why I really like these kind of simulations. And if you bought 1,000 of these $5,000 lottery tickets, the median return of your lottery ticket will be $1.1 million. So the reality of this lottery ticket, as you can see here, is that you'll have made $1.6 million. But what if you have bought 1,000 different tickets, lottery tickets? Well, on average, you'll get $1.1 million and you'll have 99% probability of making money. That's not a bad lottery ticket, right? And even if you are at the bottom 5%, the 5% unluckiest people in this lottery ticket, you still transform $5,000 into $21,000. And if you are at the top 5%, you perhaps transform $5,000 into $77 million, which is not impossible. So my question is, would you buy this lottery ticket? Of course you would, right? Anyone would buy this ticket. Now, let me tell you what this lottery ticket is in reality. It's basically allocating part of your portfolio, $5,000 in the case of this video, into TQQQ or any other leverage ETF such as SSO, UPRO or QLD if you want a little bit more diversification. You allocate a small percentage of your portfolio into leverage ETFs and hold it for 15 years. That's the lottery ticket. But it's a lottery ticket where the odds are really by your side because you have like 90-something% probability of making money and making like some serious good money. Powerball and Mark 6 and regular lotteries are really a a sucker's bet, right? Because you have like 1 in 300 million probability of making money. It's like 0.000003% of making money. But when you invest in leverage ETFs, especially when you're talking about broad indices, NASDAQ, S&P 500, and you invest for the long term, according to my simulations, and also according to reality, is that you have a 90-something% probability of making money. In fact, according to my Monte Carlo simulations, you have like a 99% probability of making money with the TQQQ if you invest for the very long term. This is not to say that there are no drawdowns, there are no risk. There is risk. These ETFs, leverage ETFs, are highly volatile. And in 2022, for example, I was already investing in leverage ETFs and the TQQQ had the drawdown of 80%. But now I'm super happy because I kept buying the dip, I kept DCAing during 2022, and now I'm super happy with the outcome, right? So if you cannot stomach the volatility, it's better you don't do it. But if you should be like Sleeping Beauty investment strategy. You know Sleeping Beauty investment strategy? I call it Sleeping Beauty because like you invest and you go to sleep for 10 or 15 years, you wake up and you'll be very, very happy. So let me give you this example. Fidelity, they surveyed their best performing accounts, and the best performing accounts were held by people that have already passed away because they didn't touch their portfolio. So very often the best investment strategy is don't touch your portfolio or do some annual rebalancing. Annual rebalancing can also be really good and important. I want to make another video about annual rebalancing because when you do annual rebalancing, you can automatically take profits from the best performing assets in your portfolio, which will be in most cases the leverage ETFs, and trickle it down to more conservative investments. For example, if you do annual rebalance on the TQQQ and you take profits by bringing down the allocation to your desired allocation and putting that money into S&P 500, you'll do very well. For example, people often talk about, oh my God, .com crash will wipe you out if you invest in TQQQ. Well, not really if you do rebalancing. Okay, back then there was no TQQQ yet, but probably if there was, I made some simulations actually around this. If there was TQQQ back in 2000, 1998, 1999, 2000, it would have performed extremely well during the dot-com bubble, right? And after the dot-com bubble, when the dot-com bubble happened, it would have dropped like 90-something%. It's crazy, it's very painful. But no one will buy TQQQ, a bag of TQQQ at the top of the market and sell at the bottom, right? Most likely what any conscious investor will do is on the way up, TQQQ is going up a lot, and every year you rebalance your portfolio, bringing your allocation from 70% back to 50% and put it into S&P 500. And if you have done that, you perform very, very well during the dot-com crash, during the financial crisis, and TQQQ will give an amazing boost to your portfolio. So looking back here at the screen, what you can see is the outcome, the expected outcome and the utility of these leverage ETFs can be really big. So imagine that just 15 years ago, you have invested $5,000 into TQQQ. Now it will be $1.1 million, the median result. And actually, as I show you here, the real result would have been $1.6 million, which is hundreds of times of your initial investment. Tell me one other investment that can perform as well as this. You probably have took profits along the way, will have rebalanced your portfolio. So maybe your result will not be exactly this in reality, but this is just to show the potential and the huge impact that leverage ETFs can have in your portfolio. Now, do you call this playing the lottery or smart investing? Which one do you think it is? Now let's go back to the concept of expected utility. Back in 1973, when Fred Smith went to Las Vegas, he was looking for utility, right? The $5,000 that he had at FedEx were not very useful, right? The company will go bankrupt anyway. So he went to Las Vegas, transferred the money into $27,000, and now he can save the company. And I think Daniel Bernoulli was the mathematician and philosopher that back in the 18th century was researching about utility. And he discovered that money has different value for different people, right? Imagine if you have $0 and you get $1,000, that $1,000 has a lot of utility, right? But if you have $1 million and you get $1,000 more, it's very minimal difference. It doesn't make any difference. It doesn't make any impact, right? So the same amount of dollars might have completely different value for different people. Now, what makes leverage ETFs different from going to the casino is, as I said before, going to the casino has expected negative value. Most likely, you will lose money. The odds are always by the house, right? But if you invest in leverage ETFs, you have expected positive value. So most likely, you will make money over the years, according to the simulations, according to the historical data. In fact, there are papers that show that if you have invested with leverage, with 2x leverage in the US stock market since like 1880 until now, so it's like almost 150 years of data, 2x leverage will give you the best returns, okay? And yes, market might have dips, we might have corrections, crashes, recessions, but it always makes new all-time highs. Always, okay? Unless we have a totally new world order and the world really changes, you will make money if you invest in the stock market, if you have invested in index ETFs, and if you invest in leverage ETFs, investing in index ETFs. So the point I want to make here regarding leverage ETFs and the TQQQ is that the expected utility for a small investor can be really massive, okay? Imagine you have $50,000 to invest, okay? And you invest $5,000 in the TQQQ and the rest into SPY, the normal S&P 500 ETF. What will be the difference? Well, what's the worst case scenario? Okay, worst case scenario, unlikely, but possible. Imagine TQQQ goes to zero. Extremely unlikely. Probably close to impossible, okay? But imagine it goes to zero. Now you'd have $50,000 is down to $45,000. It's not going to, you still do your normal life, pay your bills, okay? $50,000 to $45,000, it will not impact your life very significantly. And the reality is that if you invest only this 10% into leverage ETFs, into TQQQ, the results will be extremely different. Let's jump here on the chart. And what you can see here is I'm doing two different simulations for the last 16 years in this case. And you have SPY, 100% allocation. And what about if we do 90% to SPY, S&P 500, normal S&P 500, you know, 500 best companies in the US, and TQQQ, which is NASDAQ 100 3x. So you are investing in the 100 companies of the NASDAQ 100 index, but with 3x leverage. And you do just 10% into TQQQ and 90% into SPY. And the results are very, very different, right? So we have done the same contribution, $5,000, but the ending value is very, very different. S&P 500, $46,000. S&P 500 plus TQQQ, only 10% allocation to TQQQ, and now you have $188,000. This is very interesting. This is 4 times more money, 4 times more. So this has real utility, real utility. So getting these results, it makes a difference, right? If you invest a little bit more, if you continue DCAing into leverage ETFs and keep your allocation between S&P 500 and leverage ETFs and rebalance every year, this makes a difference. It's between having to retire at 65 years old or retiring at 40. Like I retired at 39 in Hong Kong, in the sense that I don't need to work a full-time job for anyone else, right? That makes a difference. And that's why I like these ETFs, right? The utility is really big. 40 years old retirement or 65 years old retirement is 25 years of freedom because you made some smart allocations. Another strategy that I really like with leverage ETFs, I have been talking a lot about different strategies, and I teach all my strategies in the Henri Academy. Check the link in the description. 7-day free trial. We have a 5-hour-long leverage ETF course. You can check all the strategies there. I have many members that already more than doubled their money over the last couple of years just with leverage ETFs and solid strategies. And let's jump here on the screen again. Look at this simulation here. Imagine that you do 50% TQQQ and 50% SPY rebalancing every year. And for the last 16 years, the difference is very staggering. Look at this. The difference, it's a 10x difference. You allocate the same $5,000 investment. If you just did S&P 500, you have $46,000. If you did S&P 500 and TQQQ, you have $450,000. It's 10x, okay? You can imagine that instead of $5,000, you did $10,000, and now you have $1 million. You can pretty much retire with $1 million, depending where you live, of course. You can go to a state that is a bit cheaper, or you can go to Alaska. No, I don't know. You can go to a cheaper state, or you can move to Thailand. I have so many American friends that moved to Thailand, that moved to the Philippines. $1 million in Thailand, you can retire literally for the rest of your life if you manage your money properly, because like it's so different, it's so cheap, and the life quality is so good. So the point of this video is that the utility you can get from these leverage ETFs versus the risk that you are taking is extremely good. Now, of course, let's talk about position sizing. Position sizing is one of the most important things when it comes to investing, and I need to make a video about position sizing. I talk about position sizing in my stock market course, actually. I also have like a 5 or 6 hour long stock market course in my community, link in the description. But position sizing is very important because you don't want to go all in into leverage ETFs, okay? There is some path dependency. If there is a big crash tomorrow and you are full into leverage ETFs, it's going to be very hardcore psychologically, maybe even physically. But if you have an allocation, depending on your risk profile, okay, you have 10%, 20% into leverage ETFs, that is more than enough to help you snowballing the compounding effect, accelerating the compounding effect. As we have seen, 10% allocation can give you 4 times a larger portfolio in 15 years from now. If you have the guts to go 50-50, you can allocate a small percentage of your portfolio into this, right? You can have different buckets, different portfolios. I have 2 different portfolios, in fact. I have my stock portfolio, which is approximately 50% individual stock picking, because I have fun doing it. And then I have other 50% in leverage ETFs. But this is my full-time job, okay, full-time job. So I'm not expecting you, of course, to have 50% of your money into leverage ETFs. In my case, I have, but for most people, just 5%, 10, 15% allocated to leverage ETFs, and you can follow some consistent strategies to either buy the dip or just DCA every month. Imagine you can save $500, DCA $100 every month, or $200, or if there is a dip, you allocate a little bit more. I teach all these strategies, and if you do this, nothing can go wrong unless there is a nuclear war or something like very unpredictable, a black swan that we don't know about. So again, here, if you are doing a small allocation into leverage ETFs, the downside doesn't change your life much. You are allocating 10% of your portfolio into leverage ETFs. In leverage ETFs, tomorrow there is a big crash and they are down like 50%. So you are down 50% on your 10%. That's not going to be huge negative impact for you, right? But the upside does change your life. The upside of investing 10% into leverage ETFs and 15 years or 16 years from now, you have 4 times more money, that does change your life. That it has real utility for you. So the way I like to see this is that leverage ETFs are insurance, okay? You probably have health insurance. Health insurance you pay, depending on your age and where you live, like $200 to $500 per month, and you expect never to use it, right? So the expected value of health insurance is negative. You expect to lose that money, right? Expect never to use it. But the utility is very good. If you get sick, it's very, very useful, right? Now, let's flip this around. What if you could buy wealth insurance? Wealth insurance is leverage ETFs, okay? You put a small amount into leverage ETFs, you allocate 5, 10, 15% into your portfolio, or you DCA $100 to $200 every month, and 15 or 16 years from now, your retirement account is much, much larger. Again, let me show you this example here. Let's jump on the chart. And in this example, we have basically did a $5,000 initial investment, 15 years ago, okay? And then we DCA $100 per month, only $100. So in total, we have invested $24,000 for 100, and now we have $2.4 million, okay? Just DCA, you can put a recurring buy in your brokerage account. Most brokerage accounts allow you to have a recurring buy, and you just leave the auto buy, and you have almost a 10,000% return on your investments, right? This is what I call wealth insurance. Now, let's finish this video. Fred Smith became a billionaire because he understood expected utility. He understood that you can grab $5,000 and do something really useful with it. Now, he went to Las Vegas because he didn't have any other chance to transform $5,000 into $27,000 by Monday to keep the airplanes running. But you don't need to go to Las Vegas. You can grab the same $5,000, put it into leverage ETFs, or allocate whatever is a small percentage of your portfolio into leverage ETFs. It doesn't need to be TQQQ. I talk about many other leverage ETFs. I have like close to 10 different leverage ETFs in my portfolio, okay? But you allocate a small percentage of it, and now instead of having, if you go play blackjack, it's like what? You have 40-something% probability on your side of making money. If you play perfect blackjack, you have like 48 or 49% probability, okay? Unless you're doing card counting, like Edward Othorpe. But if you're a normal person, blackjack is 48 or 49% probability of making money. So the odds are not by your side. What if I tell you that you can grab those $5,000 and you have a 90-something% probability of making money? 99% according to my Monte Carlo simulation. You probably call me a scammer, but the reality is that these are real numbers. Again, I've shown you the numbers. If you have got into TQQQ 15 years ago, you'll be very, very happy now. So these leverage ETFs can and should be held for the long term, because in the short term, they are extremely unpredictable unless you can time the market perfectly. There is no other way of making money with leverage ETFs. The best way of making money with leverage ETFs is holding for the long term, rebalance your portfolio every year, and by doing this, you have a very, very high chance of making money. And the downside is not that large unless you invest now and tomorrow there is a crash. But the markets spend most of their time in a bull market, right? You look at the US stock market last 100-something years. The average bull market is like 7 to 10 years. The average bear market is like, depending, like maybe 1 year. So most of the times you will do very well. And anyway, you are in this for the long term, so you will for sure do well. All right, guys, if you enjoyed this content, give it a like and subscribe, and let me know your thoughts in the comment section. And if you want to get into these discussions, I have so many discussions every day in my community. People are very enthusiastic about investing, about building wealth, about leverage ETFs, about regular ETFs, about income ETFs, about stock market. Join my community, because that's where the good discussions are happening. All right, guys, I'll see you soon. Bye.